Howdy, Jacob here. Today we're looking at National Fuel Gas Company. It is in the gas utilities industry, 4.4 billion market cap on 6.7 billion enterprise value. So a little bit of net debt here. They operate as a diversified energy company. They're founded in 1902 in New York. We see that revenue is nearly flat, 2.1 billion in 2014 to just under 2.2 billion in 2023. We see that their dividend yield is 4.2%. Let's look at that balance sheet. They did have quite a bit of net debt here. So 2.3 billion in long-term debt, just under 300 million in short-term debt, and only 55 million cash on hand. That's a concern for me on the balance sheet. Okay, so cash from operations have grown, but it looks like so their capital expenditures. We see that their dividend payout of 176 million in aggregate and 5-year average basis is about 150 million. So that's greater. I mean, they're going to have to cut their dividend. The gas utilities businesses are so interesting where their free cash flow is usually negative. So, I mean, I guess it's good that it's positive so I can create a present value that I'm more comfortable with. But I guess that's fine. Their use of cash flow, they've issued a bit of debt between 2017 and 2021, bought a little bit in the last 2 years. Otherwise, the babiest amount of share repurchases. Otherwise, yeah, everything else going towards a dividend. So I'm going to cut the dividend in half to where they're paying out about 90 million. And then hopefully they can start focusing on that debt repurchases, because if they have $150 million average with over $2 billion in long-term debt and only 55 million cash on hand, we're looking at 13, 14 years of their 5-year average free cash flow, which again, we don't necessarily know until we do a deep dive when that debt is due, but that can be concerning if debt is due soon and they'd have no capability of paying that off with the cash on hand or their free cash flow. And so they might have to sell off assets, which will then create a trickle down effect of loss of revenue. And then, yeah, things just go bad. So as for assumptions, I mean, I'm not seeing really much growth here. I think they'll probably grow pretty close with inflation, and then have like inflation like PEs and free cash flows since, I mean, they've been around since 1902. So again, I think they'll find ways to increase revenue. As for margins, free cash flow is way lower. Don't like that, but let's see what a 2% bump would do to their debt. So 2 billion, we're looking at 40 million in impact. 40 million impact on 150 million 5-year average free cash flow is quite a bit. Looking at over 20% impact. And so the margins are going to be slightly lower than historical. Maybe I'll do 14 and 8, 1% share change. I'm going to have to cut this in half. And then we get to a stock price that needs to fall quite a bit. 64% before we get a 15% return given these assumptions. I'm not entirely confident in this 4% dividend yield based on their payout being greater than 100% and their cash on hand being very low on their balance sheet with a lot of debt. And so, to me, not the most attractive company for a dividend yield, not the most attractive company in general. But I hope everyone enjoys the video and has a great rest of the day.